CPI okay, right in line with expectations, and the market seems okay with it so far this morning. Jim Bianco joins us from Bianco Research, president, of course. Jim, good to have you here this morning. We hit the expectations for CPI. What do you think that means for markets?
Yeah, I want to emphasize that we really did hit expectations for CPI. It's really hard to look at this report and say, well, the market should be doing X or should be doing Y. I think that there's probably going to be a relief rally because going into this report, the first half of this week, there was some worry that there might be an upside surprise, and there wasn't. And there was neither a downside surprise either. So you'll probably get a little bit of a relief rally. So if the S&P was down 31 points yesterday, it'll be up 31 points in the open, and we'll just kind of be back to where we were on Tuesday.
So looks like bonds and stocks have been a little at odds again since our S&P peaked July 27th, same day we had a big rip in the yield. What is that tolerance? What is that relationship in your mind, Jim? Are we going to get fully committed to that 2022 inverse yield stocks relationship, or will it look a little bit more like it has the last several months? What do you think?
Oh, I think we're going back to the 2022 inverse relationship. Now, that will come in fits and starts. Historically, what you've seen in the bond market for the last 20 years, that has been the outlier, that this whole 60-40 portfolio, that stock and bond prices move inversely to each other. If you look at the 100 years before that, it was the opposite. It was more like 2022. And the reason it was more like 2022 is that's the way it trades when inflation is an issue. I want to say an issue. But from 2000 to 2022, inflation was never an issue. We could forget about it at that point, and that's why we've had that outlier relationship. Now that I've said that, you can have periods of many months or even a year where it looks like the old 60-40 stocks and bonds move opposite to each other, and the bond market's a good hedge for the stock market. That could persist for a period of time. But I do think we're transitioning to a period where stocks and bonds move up and down together. That's their prices, not the yield. And because they move up or down together, as a hedge, you buy stocks, 60% stocks, you buy 40% bonds, you've got a 100-0 portfolio. They either both go up together or they both go down together.
Okay. So in 2022, indeed, when prices went down together with bonds and stocks, the outlook for the Fed, Jim, how does that fit in? Because we got Jackson Hole coming up, and Powell was hawkish there once.
Powell was probably the most hawkish speech that was ever given by a Fed chairman a year ago. 8 minutes, 28 seconds. 8 minutes and
sure
28
feels like
seconds.
A long time ago.
I know. And the speech has been dubbed the there will be pain speech. And where's been the pain, Jay? Unemployment rate is lower. The stock market is higher. I had a feeling that no one ever thought that the way you fix inflation is you just got to drive stocks higher. And that's how you get rid of inflation. You got to just drive the unemployment rate lower. And that's how you get rid of inflation. And I'm being sarcastic here. But the point is that he said that there was going to be a necessary amount of pain to get rid of inflation. We never got that necessary amount of pain. And now we've got people saying, well, the inflation rate's gone. Now, I'm going to push back on that a little bit. I think we're talking at the low of the year, the low of the calendar year in inflation in June and July, June being 3% year over year, July being 3.2. And I think the inflation rate's going to drift higher for the rest of the year. Not 9% higher, but maybe towards 4%. And I think the Fed will find that unacceptable. So currently, there's no rate hikes priced in for the rest of this year. And I want to emphasize that word, currently. I wouldn't be surprised in the next 60 to 90 days, we start talking about at least one more rate hike. And if we do that, I would then say maybe we can even talk about more rate hikes in 2024. I don't think the last chapter has been written on this inflation story. And so I don't think that the Fed is going to say mission accomplished. Let's get on to talking about rate cuts in 2024. I'm in the camp that there won't be any rate cuts in 2024.
Now, that's an important part of it because it's not just the potential next hike, it's the no cuts part. That's what the market expects. And the market also has this idea that maybe we'll get one more this year, maybe a little disagreement there too. But the big one, it seems like, is those cuts, Jim. And if we don't get those still after Powell's basically kept telling us no cuts, Why has the market been so obsessively pricing that in? When will that be firmly eradicated?
Well, let's just back up to 2020. The market has been completely wrong about the Fed for 3 years. They've been off on everything, and I think that the rate cuts in 2024 is just more of that. So the market has got to prove to me it's got it figured out now, because it hasn't for the last 3 years. It's been way too dovish. I think it's an echo of the pre-2020 era. People think we're going to go back to that. They still worry about deflation. They still think we're going to go to sub 2% inflation. I think that era ended with the pandemic. That's my view. But I would also point out, if you look at the Fed's history, they cut rates in one scenario, when they panic that the economy is going down. They did that in 2020, 2008, and 2000. They do not take a victory lap and cut rates. They did that in 95 and 98. In 95, the S&P went up 40%. In 98, the NASDAQ went up 85%. And they worried that they were fostering a bubble. So they don't do that. Yes?
Well, what about regional banks, Jim? I mean, did Powell not kind of panic earlier this year? I mean, he totally changed his tone after those regional banks.
But he still raised rates 3 weeks after Silicon Valley failed. And they skipped in June, but then they raised in July. So we've had 2 rate hikes since the March panic in regional banks. So I don't think that that's been enough to do it. But I think that this idea that there will be rate cuts next year, the Fed will only cut rates when everything's falling apart to try and stop a recession. And that's why I'd like to say, what is the worst environment to own stocks? When the Fed's cutting rates. Go back. Did you want to own stocks in late February when the Fed started cutting rates? Late February 2020 when the Fed started cutting rates? Everything was falling apart. That's when they cut rates. They do not cut rates because they say mission accomplished. And so I think that's part of this misplaced argument about what they're going to do in 2024.
Well said. Couldn't agree more on the notion that last particular point there. That seems very, very true. However, I do wonder if the market maybe has a better ability, agreed on what happens if there are cuts, but I do wonder, the market has had a little bit of a better time predicting when they go dovish and cut. Have they not? I mean, I know that the market missed that big last year, but they got it pre-COVID, which was pretty crazy, like months before. Spooky when we stopped getting aggressive in policy months before the COVID thing happened. I don't know how to explain that. But the market did get that because they said the Fed was going to loosen up. So could the market be onto something here with the cut possibly still for next year?
Keep in mind that pre-COVID, the interest rate cycle was lower. The inflation cycle was lower. Everything was working towards being dovish. That if dovish was your default opinion, it seemed to work more than it didn't work. And I think in the post COVID period, everything, at least from the bond market, interest rates are in an uptrend. You know, it was 3 years ago this week, we were at 50 basis points on the 10-year note. And now we're celebrating that we're at 399, like somehow that is somehow some kind of victory. Let's remember what the larger trend is in interest rates. It's been straight up. And that inflation, we're celebrating 4.7%, core CPI this morning. We would have been breathing through a paper bag before 2020 if we had 4.7% inflation. So we've been deadened to what's been happening. So with that uptrend in interest rates and inflation, I think it's harder to make the dovish call, which is why it hasn't worked in 21 and 22, and at least in the first part of 23, because the Fed's raised rates 4 times already this year.
Okay. So, I do think the argument's pretty sound that that was just kind of our baseline pre-COVID, right? So if you threw a dart, you're more likely to hit some kind of dovish policy tilt. All right, so if they only cut for bad reasons then, but most likely the market's wrong on it, that sounds like generally a kind of no-way situation out for stocks. Am I reading you right, Jim, then? Should we be shorting stocks, basically, because they lose in both scenarios?
Not necessarily. I mean, like I said, the worst environment is to own stocks when they're cutting rates because they cut for bad reasons, but they're not cutting rates. So we don't have that scenario right now. But as far as the stock market goes, you have to look beyond the inflation story. I'm in, and I'll use the term, the no landing camp. We like to talk about hard landing, soft landing. No landing just means the plane just keeps flying. There is no recession. we just keep going.
We've been doing trampoline landing here, Jim. The trampoline landing, bounce.
Well, that would imply that we go down. I don't even think we're going to go down in the first place. Atlanta Fed GDP is at 4% right now. Now, maybe that's a little bit high, but historically, it's only been high by a couple of percent. It's not going to go to 1% by the end of the quarter's half over, and they've got 4% growth for this quarter. We're not going to wind up with, at least historically, like 0 or 1. We might wind up with 2, but even that would be trend growth. But more likely, we're going to wind up with 3 or 4% growth. So I think we're going to have growth go okay. Now, the concern I have for the stock market is growth continues, demand continues, that there's this stickiness of inflation. The Fed might raise rates one more time this year, maybe another time in 24, no, at least as a no rate cut. That could weigh on stocks, but to some extent, that's a good problem to have, right? That you're actually worried that your economy is not going into recession. I mean, that you have a little bit of a sticky inflation problem. Yeah, that's an issue, but it's better than the alternative where everything's falling apart.
100%. Yeah. Agreed. Totally. Agreed. Yeah. You'd rather have, I've said a lot, you'd rather have rates going up, even if it's not perfect for stocks. It's definitely much better for you as an American in the workforce, right, than the alternative. Great combo, Jim. Appreciate the discussion.
Thank you.
Good stuff, Jim Bianco from Bianco Research. All right, coming up.